What's good, YouTube? Welcome back to the Stock Hustle channel with your boy William. Today is Sunday, November 28th. As always, guys, nothing that is discussed on the channel is financial advice, simply providing people financial education that I then hope they will use to understand you don't have to slave in 9 to 5s if you don't want to. You can easily hustle 24/7 in the market and still accomplish all those financial goals and dreams you've set for yourself. As with anything else in life, guys, you're always going to get out whatever you choose to put in, right? But at the end of the day, it all starts and ends with you. So today's video is going to be a little different. This is going to go into my new investor playlist. This is specifically tied to just option strategies. So for my experienced investors, this may not be a video you might want to catch up on. Again, I just want to be respectful of everybody's time. I don't want to waste anyone's time, right? This is going to talk about a lot of option strategies specifically, or you may just want to skip through the video to the parts that interest you, right? We're going to talk about buying a call, selling a call, what it means, right? Buying a put, selling a put, and what that means. And then at the end, I'm going to sum it up with how I specifically buy options, as that was the specific question that was asked to me, right? I hope this video will kind of sum it up as far as options is concerned. I know a lot of people have questions on them and how to buy them and when you buy them and when you don't buy them, right? Or what triggers do you specifically look for, right? As an investor, me, myself, right? So hopefully this will kind of sum it up for you. I am in the middle of fighting off a little cold or a flu. I'm not sure what it is. So please excuse my voice, or if I cough, I apologize. I'm going to try to do my best to keep that under wraps. But let's go ahead and get started, right? So today's video, we're going to use the ticker MU, right? Micron Technology. I recently made a DD video on this, breaking it down, doing some due diligence, right? Showing you some financials. And I called it out because of this breakout that you see back here, right? So I'm going to tie this to option strategies and how you would use options in a ticker, for example, like this, right? So first and foremost, guys, you always have to have an entry strategy and an exit strategy for any trade that you make, always, right? Plan ahead. Plan to understand what you're going to do in a play, right? Specifically, number one. Number two, you always want to find and identify a trend. The trend is your friend, right? And the reason why we call out the trend is because you don't ever want to go against the trend. You don't trade what you think, you trade what you see. Always remember that at the end of the day, especially in options. Because if you try trading what you think when the trend is going down, I promise you that is a quick way to lose money, right? I say that from experience, from when I was a new investor years and years back. So please trade what you see, not what you think, right? So first and foremost, we see that this back here when April started this downtrend, right, that you see identified on this channel on the bottom and the top side, right? So a lot of times people go into unusual whales, right, and they look at, for example, a flow, and they get really confused or thrown off by why there are buys and why there are sells of calls and puts, and like what specifically each one means, right? So we're going to break this down into segments. First, we're going to work on the calls, then we're going to work on the puts, right? So this is a flow chart for unusual whales, right? I have it segmented only to calls, bid and ask are turned on, no premium filters, right? And as you see, this is only for Friday's trades and out of the money only, right? If you don't take out of the money only, specifically why it gets a little even more confusing in the options chain, you'll see some crazy numbers, right? You'll see some numbers that we aren't even in play. We're at 83 and this was bought or sold at 77, right? Or let me find a better example, right? This bot call at 67, right? We don't want to know what people are playing for delta, which is why you always see me on my videos filter for out of the money, right? I only want to know when people are speculating. In an options chain, when you look at it, anything in purple on the call side is considered in the money. Anything in black is considered out of the money, right? So I want to know what people are thinking something will do, specifically whether it's calls or whether it's puts. The first part we're going to do is calls. So whenever you buy a call, essentially what you are saying, right? You were looking at a chart, for example, where we are as of Friday, right? We're sitting at 83.42 here, right under this area of resistance. When you buy a call, essentially what you're saying is that this price will break through this point of resistance and head to the top side, right? Now, how far will it head? What's your prediction for it? Do you feel that it will break through this next area of support and resistance, right? This is where strategy comes into play, right? What are you playing? What is your entry? What is your exit, right? But essentially, when you buy a call and you are bullish on a play going up in price, right, to specifically whatever you predict it will go to, right? Depending on if you're using unusual whales to follow the charts, right? Basically following what specifically, if it's bullish or bearish and what strike, etc., right? That's kind of how you play calls. When you sell a call, right, it's the inverse. It's bearish Because what this person is saying here, for example, right? They put this 3,000, or what is this? No, it's 100. Let's filter this by premium. Let's get better numbers, right? So here, this sold call for 100, right? So what this party here is saying for MU that sold this call at $100 for January 2023. First and foremost, take the date out of the equation, right? No one is committed to holding an option through expiration. Just like we aren't, they aren't either, right? That goes for whales and retail alike. If they go up on a play dramatically in a couple hours, I guarantee you they're going to sell it. Or if they go up in a couple of days, they're going to sell it. They're not going to hold all the way through January 2023. That'd be asinine. Why would you lock up $182,000 for that much time? Would you do that personally? Probably not, right? Just like I wouldn't, right? Personally, if I'm up on a play, I'm going to sell it, move on to the next thing, right? Don't be greedy. Because again, what drives the market? Fear, uncertainty, and greed. Those are the three factors that drive the market. Don't ever be too greedy. If you are up in a play, sell it, move on to the next one. I can't stress that enough to new investors that reach out to me and ask me for guidance. That's like one of the first things I try to teach people. Don't be greedy. But what this person here is selling you with this trade specifically, right? If we go look at a chart, what they're saying when they sold that call at $100, right? They are basically looking at this chart saying at this point here at $100, which we can draw a line. We'll just draw it here. That's close enough, right? And we'll go across and we'll make this double wide, right? What they're saying is MU by January 2023 will not be at $100. And for that, they are taking a premium payment, right? They're going to get paid premium at the tune of essentially 218 contracts, right? So we can go into an options chain and kind of break that down, what that would be like, right? We would go out to January 2023, which is here, at the $100 strike, which is here, right? They're getting paid essentially $665. Why the bid side? Because you can go look and you see that the bid side is on. So essentially they were paid $665 for 218 contracts. And again, you can do the math, right? They are essentially saying that MU by January 2023 will not be at $100 or more, excuse me, $100 or more, or excuse me, 915, 100. I'm sorry, I was reading the 110. They will not be at $100 by January 23 or under, right? So they are wanting to keep that premium, right? Now, specifically, ask yourself, why is that seen as bearish? Because you don't want the price to go up. In reality, what you're wanting is the price to go down, right? It's the complete opposite of buying a call like you see here. Buying this call for March 2022 at the 97.50, right? This person specifically wants, right, MU to go up to that point or higher, right? That's why it's option strategies, right? You either sell a call or you buy a call. Are you bearish or are you bullish on something, right? But again, what plays factored into that is the trend and when you would play something, right? For the puts, right, you buy and sell puts, for example, on downtrends like this one we were just previously in, right? This is a perfect put buying scenario, right? Some people don't like to play puts. I always try to tell people a true investor can play both top side and downside, right? You don't just play calls. You can play puts as well and ride those swings down, right? How would you do that? Well, once you've clearly identified a channel like we did here, anytime you're at the top of the channel, right, you could easily play a put and ride that wave down, right? As you see that it hits an area of support and it bounces or rejects, like right here, you have this long wick, right, where the price is rejecting. Essentially, the buyers are saying, no, we do not want the price down past this point, which is why you get this big wick on this candle and it starts to go up. You would sell your put and then switch to a call and ride the wave up again till you see, once again, look at the top of this point right here of the channel, you see these big wicks. That is the seller saying, no, we do not want the price past this point. And you see that the big wicks are formed on top of the candles, pushing it to the downside. At this point, right, you have a green candle, a red candle, and a green candle, right? Almost think of it picturing like a tower, right? Picture two towers, green on both sides, and in the middle you have the red telling you it's pushing down on the price, right? So this is an indication that the price will come down. At this point, you would sell your call and then switch to a put. And then you would ride the wave down or the swing down to the bottom side. Once again, you get to the bottom side of the channel. And again, look, very similar patterns. You see now at this new 6870 channel, there is a price rejection. Look at the big wick on the candle, right? It is saying, no, we do not want the price past this point. It actually did it up here, but if you would have held a little longer, you would have taken advantage of this other nice massive gain. And then you see what? It trading sideways for a couple of days. essentially before it started pushing back up to the top side of this channel, right? So when you buy puts, you are essentially saying you want the price to go down. When you sell a put, right, you can also use it instead of buying a call. You can sell or buy a put, ride the wave down, and then you can flip and sell a put, right? Why would you sell a put? Because what you're basically saying is, if I sold a put, for example, here, I am basically saying the price will not go past 75.98, and for that I'm taking a premium payment, right? Obviously I can't look back to the option chain for May 13th, but I can go in right now and I can find something comparable, right? So if I sold a put, for example, at the 75, right, I would take a payout of $990, right, for this week. And basically I'm saying that the price will not go below 75, and I in fact want it to go up, and for that I am paid $990. If by December 3rd or January 2023, excuse me, the price is not at $75, right, and it is above, in fact above it, I get to keep my premium. And that's how you win that. That's why it's a bullish bet, right? Obviously, this is looking out way further into 2023 and 2024. Obviously, the sooner or the closer you play the expiration, the less it's going to be, right? As you see, for the 75 for December 3rd, you're only talking $24, right? But if you played, for example, or a sold put at 83, that's $200 to your pocket. And if MU is above $83 by this Friday, you get to keep the 200, right? That's why you sell a put. It's a bullish bet. You ride a put or buy a put when you feel the price will go down. You sell a put when you in fact know or feel that the price will go up. Different strategies for different folks, right? Everybody sees things different. Again, we can look at the put side as well. Turn the calls off, turn the puts on, and look. You see some sold puts, right, at 82 for this Friday. For January and for December 17th, right? So these people are essentially saying that the price will not be below these specific amounts of money, right? When you buy a put, specifically, you want the company to go down to that price, right? So if I buy a put for December 17th at $76, what I'm in fact saying is I want MU's price to go down to $76, which would be here, right? That's midway between the next channel, right? That means it would break through this area of support at 80.25, continue down, not quite reaching the next area, but at least the midpoint, right? It's a pretty safe bearish bet. But remember, we are now in this upward trend, which we can see here, right? We have candles formulating on the bottom and on the top side. So this is a well-respected trend line that we have now started. We are a ways away. So essentially, now with the fears that we had on Friday in the market, you can kind of anticipate either to have a couple more bearish or red candle days, essentially bringing us back down to this area of support to see if we test it and confirm it. If we do, then you might see a bounce to the top side afterwards, right? Again, the market is driven with uncertainty, fear, and greed. Those are the three drivers to the market. Depending on how you see things, right, you may be, oh no, it'll go up, or oh no, it'll go down. That's what you would pretend to play when it comes to strategies, right, and options, right? Now, specifically, the other piece of the question was, how do you play strategy specifically, right? Well, as you see up here, I have volume, open interest, delta, theta, and implied volatility. These are the things that I like to look at when I'm buying my personal options that I choose to invest in. And for those of you that are wondering why, implied volatility is how you can use standard deviation to calculate out what the potential of your swing is. If you don't know what standard deviation is, I took the liberty of pulling up this chart. I've shown this before in other videos. This is a standard deviation breakdown. So let's say your ticker is $50, your implied volatility is 20. $50 times 20% gives you a $10 swing, which means that your stock price can go up to 60 or down to 40 potentially at that implied volatility. It's important to know what implied volatility you have. Theta is the decay or the amount of money you lose per day for your specific contract. So if you paid $253 for this contract, you essentially are losing 24 cents every single day, whether this contract goes up or down. It doesn't matter, right? Delta is how much you make, right? So you would make essentially 53 cents for every $1 that MU goes up, right? Added on top of whatever you paid in premium specifically. Open interest is the amount of active open contracts on a strike, on a specific strike. And then volume is how many contracts are being traded at that specific strike. It is a very bullish sign or unusual activity to see more volume than current open interest, which is why unusual well sometimes alerts for specific tickers, right? Because the volume is higher than the open interest. For example, at the 76, right? If we go back to the call side, we might find a couple. Let's see. We did this by premium. Like here, right here at the 84, you see 2,700 volume on 1,200 open interest, right? It's a pretty unusual sign, also very bullish, right? So that's how you use that. Now, for me specifically, as you guys have heard specifically, I like to trade contracts at 0.50 delta or better. The part that I don't really talk about is theta, right? Specifically, I won't play a contract when it's 50% of my delta. When my theta is 50% of my delta. That's a stupid trade. Why? Because essentially theta is eating half of my profit, right? Why would I do that? When I could easily give myself a week or two more, go out to the 17th, for example, right? Find another 0.50 and look at the delta to theta ratio here, right? Even though the alert came in maybe for the 3rd, I'm not obligated to play the contract on the 3rd. I'm obligated to find myself the best deal possible. For me specifically, this would be something good that I would trade. If I'm bullish on a strike for example this Friday, right? Let's say I feel MU will hit 85 by this upcoming Friday, December the 3rd. Me personally, I would give myself 2 more weeks, go out, find a better delta to theta ratio, like for example this, 0.53 to 0.09. I'm losing 9 cents a day, but I'm making 53 cents for every dollar MU goes up. Yeah, I'm going to pay a little more on my bid and ask. However, I'm not going to be eaten up by my theta, right? This is me personally. This doesn't have to be you. Nothing that I say is fact. Please do your own research in DD. Again, I'm just giving you the simple example of how I trade options as it was asked to me in a question and a comment. Me specifically, if there is an alert for December 3rd on a play and I see that the theta is 50% of essentially my delta, I'm not going to play that at all. I will go looking a week out first. As you see, a week out, we have a better spread here, 53 to 0.13. I mean, I could live with that, but preferably I would try to find myself the lowest theta possible, which in this case looks like it's going to be 2 weeks out for December 17th, the monthly. And I would probably go with this contract if I felt MU was going to go up specifically, right? And that applies both to put calls and puts. When I'm playing one or the other will depend on what the chart is showing me, not what I think, right? In this upward trend, I'm strictly going to focus on calls. When I see long wicks like this of price rejection, where the price is being rejected and the sellers are taking control, trying to push the price down, I'm more than likely going to play puts, especially if I have a big separation between where my ticker price is and my area of support, which is this trend line that we have drawn here, right? You can also use the moving averages to kind of guide you with that, right? I've made a video on that as well, but I hope this information helps. If you guys have questions, as always, please leave a comment down below. Don't forget, you can always hit me up on Twitter or IG as well. And if you found the video informative or the information helpful, please give me a like or just subscribe to the channel and follow along for the hustle. As always, guys, I will catch you in the next one.